Hello and welcome to Lesson 16, the Federal Reserve and Monetary Policy. So, the Fed is privately owned by the member banks and not by the government. So, it is as federal as Federal Express. The Fed is said to be publicly controlled because it is directed by 7-member board of governors who are appointed by the president to govern the Fed in public interest. The 12 Federal Reserve District banks and their branches provide many of the same functions for banks that banks provide to individuals. The Federal Open Market Committee has the power to raise and lower interest rates. The most important advisory committee to the Board of Governors is the Federal Advisory Council, which meets 4 times a year and advises the Federal Reserve Board on matters concerning the overall health of the economy. The FOMC is the Federal Open Market Committee, which consists of the Board of Governors and 5 of the 12 district bank presidents, and they make key decisions about the interest rates and growth of the United States money supply. The functions of the Fed are that they have the banking and fiscal services to the government, banking and fiscal services to member and non-member banks, and regulate the banking industry. It also tracks the money supply. It acts as the government's bank, maintains a checking account for the Treasury, sells securities and bonds, issues currency. Federal Reserve responsibilities include maintaining the money supply at all times and the payment systems, regulating and supervising all banks, and preparing consumer legislation and serving the federal government's bank. Federal Reserve notes are printed by the U.S. Bureau of Engraving and Printing, and coins are produced by the Bureau of the Mint. The payment system includes the money supply, electronic transfer of funds, clearinghouse for checks, and online banking. Some of the Fed's consumer protection activities have been transferred to the Consumer Finance Protection Bureau, but the Fed still supplies much financial information. The most important responsibility of the Fed is conducting the monetary policy. The Fed can lend funds to banks in times of need, and they charge an interest. This is called the discount rate. Regulating the banking system. The Fed requires banks to report the reserves or their liquid assets on hand. It examines banks to ensure that they are following all regulations, and examiners look at the bank's net worth to determine if they're in trouble. Net worth represents their total assets minus their total liabilities. They also must regulate the money supply. The Fed is best known for regulating the money supply. Factors that affect the demand for money include cash needed on hand, interest rates, price levels in the economy, and the general level of income. The laws of supply and demand work the same for the money supply. Under the fractional reserve system, banks are required to keep a portion of their total deposits in the form of legal reserves. Banking with fractional reserves results in monetary expansion process that increases the total money supply available to the public. Monetary expansion continues as long as the bank has excess reserves to lend and as long as lenders deposit part or all of that money. Monetary policy refers to the action the Fed must take on economic performance. The Fed can use the money supply in many ways. The Fed conducts money policy to expand or contract the money supply and affect cost and ability of credit. The Fed changes interest rates by changing the size of the money supply. There are 3 tools that the Fed uses to conduct monetary policy, and they are the reserve requirement, open market operations, and the discount rate. The Fed can raise and lower the reserve requirement, but it rarely uses this tool because other tools work better. Banks keep a certain amount of money on hand, and this is called the reserve ratio. required reserve ratio. Banks keep excess reserves on hand, and more money is required by the RRR. The Fed can influence the economy by changing the required reserve rate at any time. The Fed's most popular monetary policy is the buying and selling of government securities in the financial market system. This is also called the open market operations. The discount rate is the interest rate the Fed charges on loans to financial institutions. Although the Fed directly sets the discount rate, the rate influences other interest rates, including the prime rate. There are monetary policy dilemmas. Leads and lags in the time it takes for policy to take effect make it difficult for the Fed to know exactly when to pursue or abandon a policy. Monetarism is the philosophy that allows the money supply to grow at a steady rate, at levels low enough to control inflation. Monetary policy can change interest rates, but the economy is not always responsive. Changes in interest rates can only do so much. The quantity theory of money is the hypothesis that the supply of money directly affects the price level over a long term. The wage price controls imposed by President Nixon in the early 1970s did not work. Prices rose even though wage and price controls were in place. So let's look at monetary policy and macroeconomic stabilization. Using the monetary policy. Monetarism is the belief that the money supply is the most important factor in macroeconomic performance. Money supply and interest rates. In the basic terms, the interest rate is the cost of money. It works under the principles of supply and demand. When money supply is high, interest rates are low, and when the money supply is low, the interest rates are high. When money is in low supply, the Fed may allow for easy money policy or follow policy that will increase money supply. When money is in high supply, the Fed will try to lower the money supply, or they call it the tight money policy. Policies of monetary policy need to be carefully enacted and to have a desired effect. If they are not timed accordingly, they may have a negative effect on the business cycle and thus have a negative effect on the global economy. Like fiscal policy, monetary policy takes time to put into effect, such as lags. There are inside lags and outside lags. An inside lag is delay in implementing the monetary policy, whereas an outside lag is the time it takes for the policy to actually have an effect. Discretionary fiscal policies were popular in the post-World War II period, but their popularity declined after President Reagan took office. The Federal Reserve System has filled the void left by the decline of discretionary fiscal policy. The Fed is much more responsive to economic issues than the federal government. Supply-side policies have been popular, but they did little to help the economy that slumped in 2008. Policies used to stabilize the economy during the Great Recession included monetary policy, quantitative easing, and passive fiscal policies. In recent years, the fields of economics and politics have really merged. The main reason for different opinions among economists is that they place different importance on various problems. Most economic theories are a product of their time. As time and issues change, so does economic theory. The President's Council of Economic Advisors is a three-member group that reports economic developments and proposes strategies. Economists have helped the American people become more aware of workings of the economy, which benefits everyone. This ends the lesson. Make sure that you fill out your guided video form or your video notes and turn them in and take your mastery check.